Welcome to this explainer. Today, we're diving into what is honestly shaping up to be the most astonishing corporate earnings update of our entire generation. We're looking at NVIDIA's Q2 FY 2027 results. But look, we aren't just going to sit here and gawk at the massive numbers making all the headlines. We're going to dig deep into the under-discussed, hidden risks and unpack what all of this actually means for your portfolio positioning. Let's get right into the headline that literally changed everything. If you only take one single thing away from this explainer today, make it this specific number: 70%. NVIDIA just straight up told the market that it expects to grow its revenue by 70% next year. Now, to put into perspective why that is so earth-shattering, you have to look at what the experts were expecting. Wall Street was modeling a 45% growth rate. Reality? 70%. That is a massive 25 percentage point gap between expectations and reality. Now, what's really interesting about this is how the market reacted, and it was truly historic. Because of that massive expectation beat, NVIDIA's stock jumped 9% overnight. In sheer dollar terms, that added a staggering $440 billion to NVIDIA's market cap in just a matter of hours. But as an investor, you really have to ask yourself, is this kind of hypergrowth actually sustainable? And more importantly, is the stock still a buy at these elevated levels? To help us navigate all of this, here is our roadmap for today. 1. Numbers defying gravity. 2. The hidden financing risk. 3. The concentration trade. 4. Portfolio positioning. And 5. Catalysts to watch. Okay, let's dive into Section 1, Numbers Defying Gravity, and break down these financials. Just look at these figures. For Q2, revenue came in at $96.2 billion. That is up 106% year over year, beating consensus estimates by about $4 billion. And the main driver there? The data center division alone did $89 billion, which is up 117%. Again, these are literally the kind of growth metrics you'd expect from a scrappy hypergrowth startup, not a mature company sitting at a $5.4 trillion valuation. But the real story is looking forward. The Q3 guide is $108 billion, beating the $104 billion consensus, and looking all the way out to FY 2028, they're guiding for roughly $680 to $720 billion in revenue. At the top end of that range, we're looking at a potential $450 billion in operating earnings at their current margins. Now, when you compare those operating earnings against today's massive market cap, you'll see the stock is trading at roughly 12 times forward earnings. For a company growing at 70%, that is actually not expensive at all. If you adjust for growth using the PEG ratio, NVIDIA's current PEG is below 1. Historically, it's traded above 2. So what does this actually mean in plain English? It means the stock is roughly 40% undervalued versus its own history. This is literally the cheapest the stock has looked relative to its growth in 3 years. The bull case here is crystal clear. You're buying into a company with fortress-like margins, accelerating growth, and a valuation that is highly compressed right now. But let's pivot sharply from the hype to the hazards. Section 2, the hidden financing risk and a $500 billion danger no one is talking about. Here's the deal. NVIDIA is increasingly acting like a bank. They're using special purpose vehicles, or SPVs, to help customers finance these massive GPU purchases. On the surface, this is incredibly smart, right? It unlocks demand from smaller customers who couldn't otherwise afford to buy these giant compute clusters. But the absolutely crucial point here is the collateral. GPUs depreciate incredibly fast. In just 24 months, today's top-of-the-line H100 chips will be worth only a fraction of what they cost today. If AI spending slows down even modestly, the value of that collateral could absolutely crater. Michael Burry, the investor famous for calling the 2008 housing crash, has actually compared these financing vehicles to pre-2008 mortgage structures. It is a really stark warning about what happens when the underlying asset backing a massive loan rapidly loses its value. But to remain completely objective, we do have to look at the flip side here. The contracts backing these loans aren't just relying on the chips themselves. They're backed by investment-grade hyperscalers. As long as tech giants like Microsoft and Meta are on the hook, that risk sits squarely on their massive balance sheets, not just floating in the wind. However, as an investor, this is a structural risk you absolutely must monitor. Watch very closely for any signs of financing terms tightening or if hyperscalers start pushing back on their take-or-pay commitments. Let's move on to Section 3. The concentration trade, and the growing single-stock risk. Notice this really stark contrast over a recent one-month period. NVIDIA's stock jumped 20%, while the broader semiconductor ETF, the SOX, barely moved at all. Competitors like AMD and Intel were up just 10%. What this tells us is that AI CapEx dollars are concentrating almost entirely on NVIDIA right now. That's undeniably great for NVIDIA in the short term, but the market is dangerously pricing the stock as if NVIDIA is going to have zero data center competition for the next 2 years. And the reality is, competition is coming. It's inevitable. AMD's MI400 and Intel's Falcon Shores are on the horizon. They will be competitive options, even if they don't take the absolute top crown. As global chip supply catches up with demand, NVIDIA's immense pricing power will eventually moderate. It might not be a near-term concern for this specific quarter, but it is absolutely a 2028 and 2029 concern that the market seems to be totally ignoring. All right, let's get into Section 4, portfolio positioning and our actionable takeaways. So what should you actually do with all this info? Well, here are 3 specific strategies based on your current posture. First, for the long-term believers, remember the stock is volatile and still 15% off its all-time high. Look for pullbacks around that $220 support level, or simply wait for the next high-bandwidth memory supply headline to create a solid buying opportunity. Second, if you're overweight in semiconductors, use this rally to rebalance. NVIDIA is now roughly 6% of the S&P 500, which means if you own the index, you already have huge exposure. A modest trim into strength is pretty wise. And finally, if you're sidelined right now, consider starting a half position with a clear intent to add on any 10% correction. For those of you building that long-term position, strategic moves like the recent $13 billion Hugging Face acquisition are exactly what you want to see. This acquisition significantly deepens NVIDIA's CUDA software moat, which is their core programming ecosystem, and it really strengthens their long-term case for dominating AI infrastructure beyond just the hardware. Finally, let's look ahead to Section 5, 3 catalysts to watch over the next 90 days. To wrap up our horizon planning, here is your rule of 3 for the current quarter. Number 1, the Vera Rubin cycle ramp. CEO Jensen Huang expects this to contribute about 20% of data center revenue this quarter. If it comes in higher, expect a nice upside surprise. Number 2, HBM memory supply. High bandwidth memory is the core bottleneck in the industry right now. Any news of Samsung or SK Hynix ramping production faster than expected is a major tailwind. And number 3, hyperscaler capex. Microsoft, Google, Meta, and Amazon are reporting soon. If they guide their capital expenditures up, it just confirms this massive spending cycle still has very, very strong legs. I want to leave you with this final, somewhat provocative question. NVIDIA is without a doubt a generational company, but is the path to a $5 trillion market cap a straight line? The answer is no. The AI trade isn't over, but the easy money, that's probably already been made. Stay disciplined, be patient with your entry points, and keep your position sizing reasonable as we navigate these unprecedented growth numbers and those hidden structural risks.